I want you to picture something for a minute.
Mhm.
Imagine you have this physical booklet, like a real passport, and it's in your pocket right now.
Okay.
But instead of getting you on a plane to Paris, this thing,
Mhm.
it determines where you can go in your own life.
So not for countries, but for opportunities.
Exactly. You want to buy a house, some border agent at the bank needs to see the stamp.
Yeah.
You want a car, show the passport.
And if it's empty?
If that booklet is empty or, the pages are all torn up, the answer is a hard no.
It's a great image, isn't it? Because we all know where our real passport is. It's in a safe or some special drawer.
Right.
But this financial one, most people don't even know they're carrying it. Not until they get stopped at that border.
That's the thing. We think cash is king,
Good.
I have the money, I should get the thing. But for today's deep dive, we're looking at a source called the Financial Passport.
Building and protecting credit history.
And it argues that the whole system runs on a completely different kind of fuel. It runs on trust.
And not just some, vague, fuzzy kind of trust. We're talking about trust that's been turned into a mathematical formula.
An algorithm.
An algorithm that decides if you're reliable before you even say hello.
So that's our mission today. We're going to decode that formula.
Yeah?
We're going to figure out why having no debt, which sounds so responsible,
It sounds like the goal.
why that can actually be a trap. We'll break down the math behind that 3-digit number, and we're going to look at this idea of a social contract, which I think really changes the whole game from money to reputation.
And what I love about this text is that it avoids, just throwing numbers at you. It frames everything through these two characters. You've got Sean, the economist, very precise, data-driven.
And then there's Annie. And I feel like a lot of us have been Annie.
Oh, for sure.
She's a bit impulsive, but she's learning. She thinks she's doing everything right, pays cash, avoids loans, but she just keeps hitting these walls.
Right. Annie is that gap between what feels like common sense and what the credit system actually values. They're often total opposites.
Okay, so let's start with the big idea here. The source defines credit history as a dossier on all your financial obligations.
That word dossier, it sounds so serious, like something out of a spy movie.
It's meant to be. It's telling you this isn't just a snapshot. It's a permanent record. And it makes this really crucial distinction between facts and promises.
This is that social contract idea. It's all very unemotional.
Yeah.
In our lives, relationships run on promises. If you tell me you'll get lunch next week, I believe you. We have that rapport. But a bank is an institution.
It doesn't have feelings. It's not your friend.
Not at all. The source is blunt. Banks do not believe your words. They only look at facts.
And the only facts they care about are, did you borrow? And did you pay it back on time?
That's it. That is the entire game. Everything else is just, noise.
To make this point, Sean uses this analogy in the text that I found really helpful because it takes the money out of it. He compares it to your reputation in school.
The library book analogy.
Sure.
So simple, but it works perfectly.
So imagine you're a student. You borrow a library book, a cheap paperback, nothing special, but you lose it. Or maybe you just don't return it.
Yeah, you just forget.
The school makes a little note on your record. It's a tiny thing, right? Who cares about a $10 book?
In that moment, yeah, it seems like nothing. But then, fast forward a few years, now you're a senior, you need to borrow a really expensive microscope for a science project.
And you go to the office, and they pull up your file.
And there it is, the missing paperback from freshman year.
And their logic is simple. If we couldn't trust him with a $10 book, why on earth would we trust him with a $5,000 microscope?
It's the pattern. The stakes get higher, a mortgage versus a credit card, but the underlying principle, the discipline, is exactly the same.
The source is saying if you can't handle the small stuff, the data predicts you won't handle the big stuff.
It calls this your financial biography, and you're writing it every single month. Every payment is a sentence.
And a missed payment is a really bad plot twist.
A really bad one.
I like that idea of a biography. But it's also kind of scary. You can't just go back and edit the early chapters. But okay, let's get to the part that really flipped my thinking. The Annie situation.
Ah, the no history trap. This is where so many people get tripped up.
So Annie, in the source, she's so proud. She says, I never borrowed money. It's like a badge of honor for her.
She thinks, I don't owe anyone anything, so I must be the safest person in the world to lend to.
It makes perfect sense, right?
Okay.
But Sean, our economist, he just pops that bubble.
Mm-hmm.
And he uses a term that I think is maybe the key takeaway here, the dark horse.
The dark horse. And usually that's a good thing, like an underdog who wins the race.
Not here.
No. Here, it's a threat. To a bank, a person with no credit history is a dark horse. The source says the risk for an unknown is basically the same as the risk for someone who never pays their bills.
Okay, wait, hold on. Walk me through that. How is having no debt the same as having bad debt? That feels completely unfair.
It does feel unfair, but you have to think like the algorithm. The bank is a prediction machine. It uses past data to predict future behavior.
Right.
If you have bad debt, the machine predicts you'll fail to pay. Simple. If you have no data.
A machine can't predict anything. It's a blind spot.
Exactly. It doesn't know if you're good with money. It only knows you're a stranger. You could be a secret millionaire, or you could be someone who's about to lose their job. The bank has no idea, and banks hate question marks more than anything.
So when Annie goes to get a mortgage in the story, she's rejected. Not because she's bad with money.
But because she's invisible, she's a ghost, and the system can't lend money to a ghost.
That's the trap. You think you're being safe, but you're actually just opting out of the only game that matters. You're refusing to write your own biography.
So the strategy the source proposes is, well, it's pretty counterintuitive for people who hate debt. It says you have to play. You have to start building a history, even with tiny amounts, just to prove you exist.
You've got to show you're willing to participate in that social contract.
Before you get the benefits of it, yeah, you need a track record.
Okay, so we need a track record. We need to fill the pages of the passport. Let's get into the mechanics of it. The credit score. That number, 300 to 850.
The mathematical expression of trust.
I love that phrase. It sounds way too philosophical for something that decides if I can lease a car.
But it's literally what it is. It's quantifying how much a stranger should trust you. And the source actually gives us the formula, or at least the three main pillars.
Right. So for everyone listening, think of a pie chart. The biggest piece of that pie, a massive 35%, is payment discipline.
This is the foundation. It's just answering one question: did you pay on time? That's it.
It seems so obvious, but it's weighted so heavily that if you mess this one up, nothing else really matters, does it?
Pretty much. You can be perfect everywhere else, but a few missed payments and your score just tanks. Reliability is 35% of your grade.
Okay, so just pay your bills. That's a third of it. What's the next big chunk?
The next 30% is debt level, or what they call credit utilization.
Which is just how much of your available credit are you using?
Exactly. And we should put a pin in that one because there's a specific 30% rule we need to get back to.
Okay, so that leaves another big piece of the pie.
Right. The third key factor the source points out is age of history. It's 15%. And this is where Annie makes a classic mistake.
The cutting up the old credit card mistake. I think I've done this. It feels so responsible.
So many people do. Annie thinks, I'm not using this old card from college. I should just close the account, clean things up.
It's like financial decluttering, right?
Yeah.
Get rid of what you don't use.
But Sean explains this is a mathematical disaster. The score cares about the average age of all your accounts.
Okay, let's actually do the math on this because it's a bit tricky.
Yeah.
Say I have one card I got 10 years ago
Okay.
and a new one I just got this year.
So you've got a 10-year-old account and a 1-year-old account. The average age of your history is 5.5 years. That's pretty good. Shows stability.
But I never used that old card. So I call them up, I close it.
And now your average age drops from 5.5 years to 1 year. Instantly.
Ouch. So in one phone call, I went from looking like a seasoned pro to a total rookie.
Boom, your score drops. You voluntarily erased the proof of your long-term reliability. You just tore out the first 10 chapters of your own biography.
That is just, it's wild. The system is actually punishing you for tidying up.
It is, because longevity is stability. The source is very clear. Keep that old account open. Buy a pack of gum on it once a year to keep it active. It anchors your entire history.
It's like having seniority at a job. You don't just quit to start over at the bottom.
Perfect analogy. Don't fire yourself from your own credit history.
So we've got payment discipline, debt level, and age of history. Those are the big levers.
Yeah.
But the source also gets a bit dark here. It talks about how fragile this whole thing is.
Yes, the hard truth section. Sean points out that mistakes, like delinquencies, missed payments, they stay on your record for 7 to 10 years.
7 to 10 years. That's a lifetime. You could be a completely different person by then.
But the dossier remembers. The algorithm has a very long memory, and the source is explicit. There's no quick fix. You can't write an apology letter to the credit bureau.
You can't explain that you just forgot.
Nope. The only remedy the text offers is new, long discipline. You have to bury the bad data under a mountain of new, good data.
That sounds exhausting.
It's supposed to be. It's a deterrent. It's why maintenance is so much easier than repair.
Okay, so let's get into tactics. Sean gives a few best practices to keep your passport in good shape. We already covered the age thing. Don't close old cards. What else?
There's this idea of application velocity.
Velocity, as in speed.
Right. The source warns against applying for a bunch of loans or cards all at once.
This sends up a red flag, right? It looks like you're desperate.
Totally. If you apply for 5 cards and a car loan in 1 week, the algorithm sees this huge spike in activity. It looks like you're in financial trouble.
Like you just lost your job and need cash. Fast.
Exactly. It screams high risk. So the advice is simple. Space it out. Apply for what you need when you need it.
Okay, got it. So now let's circle back to that utilization piece. The 30% rule. This feels like the most actionable tip, but also the most misunderstood.
It really is. The rule is, try never to let your reported balance be more than 30% of your credit limit on any card.
Okay, numbers. If I have a credit card with a $1,000 limit.
You should never have a balance higher than $300 showing up on your report.
Now here's the trap. People think, well, I pay my bill in full every month, so my balance is always zero. But that's not how it works, is it?
That is the crucial detail everyone misses, even if you pay it off. Because the bank reports a snapshot of your account on a specific day of the month, usually your statement closing date.
Which is before your payment is due.
Exactly. So if you charge $900 on that $1,000 card, fully intending to pay it off next week.
If the snapshot is today, the credit bureaus see you at 90% utilization. You look maxed out.
Even though you have the money sitting in your bank account to pay it off. The algorithm doesn't see your bank account. It sees the debt level versus the limit.
So it's not about being able to pay. It's about restraint.
Restraint is the perfect word. If you have access to $10,000 and you spend $9,000, you look impulsive. If you have that same limit and only spend $1,000, you look disciplined.
The algorithm rewards people who could spend more but choose not to.
That's the signal of stability. That's the flex.
Okay, and the last piece of advice from Sean is just monitoring.
Yes. Check your history once a year. It's free. You have to do it because errors happen all the time.
Right. You don't want to find out there's a mistake when you're sitting in the mortgage office.
Absolutely not. You have to proofread your biography before you show it to anyone important.
You know, the more we talk about this, the more it comes back to that central idea of the social contract.
It really does.
The system gives you this incredible leverage, the ability to buy a house with money you don't have. But the price is total financial transparency.
It's a trade-off. You give up your privacy, you let them track your biography, and in return, you get access to capital. You get trust.
And that's the core of this text. Your reputation isn't just a feeling. In finance, it's a data set.
And that data set, as the source says, is built over years. But it can be ruined by one forgotten payment.
It's a sobering thought, but it's also empowering, I think. Because once you know the rules, the 30% rule, the dark horse, the age of accounts, you can actually start to play the game. You can write your own story on purpose.
You can, but you have to pick up the pen. You can't leave the pages blank like Annie did. You have to engage with the system to master it.
So as we wrap up this deep dive into the financial passport, here's the thought I want to leave you with. We've been talking about this score as a kind of biography.
Your financial biography.
Right. So if your credit history is a book that the banks are reading right now, what genre is it?
Ooh, that's a good one.
Is it a thriller full of risky moves and cliffhangers where you almost miss a payment? Is it a mystery novel, full of blank pages that make them suspicious?
Or is it the most boring, predictable, repetitive history textbook ever written?
Because in this particular library, boring isn't bad.
In this library, boring gets you the keys to the house.
So go be boring. Thanks for listening to The Deep Dive.
See you next time.